Is the housing market slowing down? In this video, we're gonna go through a couple of recent data points that are indicating things are gonna take a breather. We're gonna go through if the market's slowed down. Nate's got a bunch of data that's just come out indicating that it could, and it might actually be good news for home buyers. We're gonna give you our opinion on what needs to be done and what we think should be done to help people out, because it's just too much. 100%.
Before we start this video, if you find it helpful in any way, do me a little favor and hit the like button. Or leave a comment below for the YouTube algorithm. Just a little gesture like that can make a huge difference to the channel. And if you haven't already, consider subscribing below. So thanks you guys, it really means a lot to us, and let's dive right in.
So I guess the first thing I wanted to touch on today, Jaden, is I came across this interesting article titled New South Wales Property Prices to Peak. So the non-stop rise in housing prices may hit its apex this year, according to the latest expert predictions. The Finder RBA cash rate survey revealed the majority of its economists, 68%, believed prices in New South Wales will hit their peak this year, while the remainder believe that'll come in 2022. Jaden, I guess we've seen in the last 18, 24 months, the housing market's definitely picked up. What are your thoughts on this? Do you think the market's gonna actually peak, as most of the economists are predicting later this year?
It can't keep going up forever. There's been times in recent history where the market plateaus and it goes through periods of stagnation. If you look at the property clock, you'll remember that the market moves in cycles. Now looking at this month's latest property clock from Heron Todd White, you can see almost all of Australia, the whole market is on the left-hand side, the rising market. But at some point, you need to hit the peak of the market. It can't go up forever. So at some point, it's gonna start to decline and you'll be in a declining market. What we've seen in recent history is this happen in a bunch of times. So I actually found this really good article from Michael Minchizik showing the last 140 years of property data in Australia. Now it charts all the way back from 1881, where the median house price in today's dollars was $59,000 in Australia to buy a home. Like, can you imagine that?
Nuts, that's
It's
crazy.
insane. And it shows all the big drivers of property growth over the last few years. Now, interestingly, all the most recent ones have been credit driven. So anytime that the banks have made it a bit easier or sometimes made it a bit harder for credit growth, there's led to either growth in property prices or stagnation. And this is an interesting one that Minchizik breaks down in here. We'll include links below. But once he pulled out property price growth after inflation, so there were years when mum and dad looked like, oh, interest rates were 17%, we were so great. Yeah, inflation was 10% at that time. So real property growth wasn't quite that. But what happens is, as you can see from the chart here, after rapid price growth, there are years of stagnation and no real growth, because they look at the property growth figures, and while the average over the last 100 years has been 5.8% property growth per year, once you take out inflation, it drops to about 2.2% per year. And that's what we're expecting to come up in the short term potentially. It looks like the property prices might go up a bit in the short term, but at some point, it could be the next year, it could be the next 2 years, it could be the next 3 years, it's gonna slow down and there'll be a period of stagnation where it'll kind of go sideways for a period.
Now, interestingly, only looking back 18 months ago, a lot of economists were predicting that prices could fall 20, 25%. Now we're in record territories where a lot of places have had record month-on-month growth. Graham Cook, who's a head consumer researcher at Finder, also said increases can't go on indefinitely. Current rise in prices and activity are set to peter out by 2022, he predicts. He also goes on by saying for first homeowner, this means that the bottom rung of the housing ladder should stop becoming steeper within the next 6 months.
Well, and that's the thing that we've noticed. Like, how many home buyers have you spoken to, Nate, that we spoke with? Speaking with a couple this morning, in January, they were ready to buy a home in Brisbane for $600,000, and it was totally doable at that point. Like, the market
100%.
was all possible. Fast forward to now, we're over halfway through the year, and they're saying, I can't buy a house. I'm gonna have to look at a townhouse, maybe even a unit, because that $600,000 house selling for $750,000, $800,000, and my deposit hasn't got to that point.
Not to mention, from the start of the year, it was fairly easy to go to a private treaty, put an offer down, negotiate, go back and forth, and the deal would be done. Now we're seeing situations, Jaden, where there's 10, 20 different offers on the one property, which is really pushing that price growth that we've seen.
Pretty wild.
I guess this is backed up by recent data. Australian house prices ticked up by 1.9% in the month of June alone. That brought the annual growth in the financial year 2021 to an eye-watering 13.5%, according to recent figures released by CoreLogic.
13.5% is huge, but have a look at some of the people overseas, because that hasn't been uncommon during the lockdown, because there's actually been a lot of these trends, not just in Australia, but abroad. In Sweden, in the last year, there's been year-on-year increases of almost 20%. Denmark, a similar situation, 16%. Russia, the US, it's been berserk. So unfortunately, it's not a problem that we've had just in Australia.
Cook explained that rising property prices have led to unprecedented borrowings. ABS data shows that Aussies borrowed 75 billion for the first 4 months of 2021. Compare this to 48 billion in the first 4 months of 2020.
Now, one thing we haven't seen a lot of is investors, property investors. The latest boom has been driven mostly by first home buyers up until the month of May. Now you can see investor lending has soared more than 13% in May, or 115% higher for the same time last year. And that's what happened last time. In the last a couple of years back, APRA put the brakes on the property market by tapping on the investors. Now, Nate, I know you said this happened a couple of years ago, even with Reserve Bank. So it could be another way that the RBA or even the bank's going to intervene to slow stuff down.
Yeah, we've seen this happen 2 times previously, once in 2002 and another in 2008. Back in 2002, the US economy took off and the Australian property market went with it. Back then in 2002, the Reserve Bank governor had to tap on the brakes to cool down the market. It took 2 years for the property market to stop growing and steady out. And then again, we saw this in 2008, where the Rudd government came out with a bunch of incentives for first homeowners, and investors started getting really speculative on property. APRA actually had to come in and slow the investment market down by putting a bunch of regulations in.
Yeah, and that has been a big change that we've noticed over the last 12 months, 2 years. During the Banking Royal Commission, which happened from 2017 till February 2019, the banks were pretty scared. They were pretty worried that there's going to be more regulation, that things will get slowed down, and they're going to get looked at more thoroughly. So what did you notice?
We saw the lenders really tighten up on credit criteria back then. They were looking at your living expenses. If you were outside the box, they were just saying flat out, no, we're not going to lend to you. And we actually saw the market sort of dip. There are times there where we're actually sitting around twiddling our thumbs, wondering what was happening because there was no one inquiring.
And it was mostly a knee-jerk reaction. The banks were really concerned that the regulators were going to stop in and say, you guys are being pretty loose, you're lending people too much money, we want you to slow down. And they were asking questions like, if people's saving after rent wasn't going up month on month, they thought they weren't credit worthy and they wouldn't give them a loan. Fast forward to today, and after a bunch of cases where it was okay, the court system's determined you can have Shiraz and Wagyu one night and you can cut back the next night to afford your mortgage. They've taken a bit more of a loose view with living expenses. So what are you seeing now with that, Nathan?
Yeah, 100%. I mean, it's chalk and cheese. Getting a loan approval in today's market is 100 times easier than what we were finding during the Royal Commission. And I guess the numbers speak for themselves. We can see lending's doubled last financial year to this financial year, and the market has gone with it.
And I guess for the regulator, it's been hard because it's been an owner-occupied, first home buyer-driven market. It's hard for them to put the brakes on because they're saying, well, we want to be able to help affordability. We want to help more people in the market. There's a first home loan deposit scheme. There's a first homeowners grant, home builder grant that has helped some people, but also it's blocked other people out because it's pushed prices up to a point where, all you can afford is a unit in Sydney for $500,000 more, for a studio. So yeah, it's not worked. Hopefully it's going to naturally slow itself down because you've noticed some of the banks, CBA's recently put up their assessment floor rate. So it means that potentially they'd lend you a little bit less than they would have a couple of weeks back. But it's still, compared to 12 months ago, a lot easier to get a loan than it was, during the Royal Commission.
100%. The vast majority of economists agree that housing is becoming unaffordable. Noel Whittaker from QUT pointed out, you only need to look at the average wage numbers against the average house prices to understand why housing is becoming more and more unaffordable. Tony Mackin from Griffith University also warned that a real estate bubble is emerging due to the extreme low interest rates. So Jaden, we can see in this graph here, consumer sentiment around housing affordability, cost of living and household debt is all pretty low. What are your thoughts on that? And what should the government really be doing to try and tackle this head on? Because they've released a bunch of schemes to help first homeowners in the market, but do you think that's actually addressed the real issue that we've got here? We saw a report recently that came out and advised that people under 35 are being locked out of the market. They compared from 1990s, and 50% more first homeowners are struggling to get in the market than there were back then.
I think the government needs to be doing way more for first home buyers. It could be done by way of better stamp duty concessions. So the caps in Queensland, for example, it's only on homes up to 500,000, stamp duty is waived, and up to 550,000 it's discounted. In Sydney and Melbourne, it's a similar situation where the caps for what people are getting discounts on as first home buyers aren't really reflective of what it costs for a home now. In any inner city suburb in Brisbane, like you're paying $600,000-$700,000 for not much house compared to what you would have got 2 or 3 years ago. So I think that needs to be addressed. It's the same thing in Sydney. I think it's a $650,000 or $700,000 cap for stamp duty. In Melbourne actually did a bunch with reducing it and doing some discounting, but I think they need to do more. The grants potentially need to be revised. A lot of that's pushing people into new housing, and then you just need to look at Opal Towers or the Mascot Towers and look what outcomes that can lead if they're building lots of stuff that needs to be built quickly. It's making first home buyers buy apartments and buildings that you might not be able to do due diligence, or you just need to be careful with that. And even the First Home Super Savings Scheme, I think it's a wonderful scheme. It's massive what you can do with it, but no one uses it. It's so complicated. It's beneficial, but they could do more with that. Potentially allow you to use super like in other countries. There's other schemes in Canada where the government does like a shared equity situation. So I think there's a bunch they can do that everyone's just kind of kicking the can down the road and hoping it solves itself. Nate, so the $1 million question, if I want to buy a house, why would I buy it if it's potentially not going to go up in the next 5 years? What's the benefit?
Now, we've always talked about it. It's not about timing the market, it's about time in the market. And although, yes, the market might go down, who knows what will happen? As I said before, economists were only predicting houses might go down by 20 to 25% 18 months ago. The opposite actually happened. It's really hard to know what will happen. I think for those out there thinking about getting in the market, it's all about your long-term plans. If you're buying and holding over the long term, well then what we've seen traditionally is that the market does go through a period where it recovers and then builds back up. However, if you're thinking of getting in for the short term, you might need to rethink your strategy.
Yeah, we were saying before COVID, when people were saying there's 40%, there could be 40% drops, maybe there's 20%, possibly there's going to be 10%. And you know what, there could be, but all those people were wrong. And we don't know what the future's going to hold. The reality is, if you're going to buy and sell in the next 12 months, we said it before, we say it again, and you worry about market drops, don't buy. Keep renting. There's nothing wrong with that. If you're going to hold the property for 5, 10, 15 years, you take that long term, you just need to look at the charts. Definitely check out that Matusik article, because like you can see, over time, after inflation, property has performed relatively well. It's been a very resilient asset over the last 100 years. So check it out.
So guys, we'd love to get your feedback. Please leave a comment below. We read everyone and reply to them as well. Thanks for watching, and remember to smash that like button and hit that subscribe, and we'll see you next time.